Hey, everybody. Welcome to guided assignment for chapter 21. I guess that's my whole preamble. I'll just get into it. So this is the Kimbrell company, Kimbrell Inc. They manufacture 3 sizes of utility tables, small, medium, and large. An income statement has indicated a net loss on the medium size, and management is considering 3 proposals. 1, to continue size medium. 2, to discontinue size medium and reduce the total output accordingly. Or 3, discontinue size medium and conduct an advertising campaign to expand the sales of size small, so the entire plant capacity can continue to be used. Then it gives us some additional stuff here. If proposal 2 is selected, the size medium is discontinued and production curtailed, the annual fixed production costs and fixed operating expenses could be reduced by this amount. So if you see that, it's not actually their full fixed amount. So some of this fixed amount is, if you think about it, it's being, they're using some of the methods we learned in earlier chapters to divide up that fixed amount across these various products and allocate the fixed costs. And so when we get rid of the product line, we don't necessarily get rid of all the fixed costs. So those would just have to be reallocated to the other areas. And if proposal 3 is selected, it's anticipated that an additional annual expenditure of $85,050 for the salary of an assistant brand manager would yield, which is a fixed operating expense, would yield an additional 130% in size small sales volume. Also assume that the increased production of size small would utilize the plant facilities released by the discontinuance of size M, meaning that those fixed expenses of the plant would remain the same. They wouldn't change. All right, so let's take a look at this. We have all of this data given to us, and then the first thing it wants us to do is prepare an income statement and variable costing format. So we can do that. So the first thing is that sales will remain the same regardless of whether we're using absorption or fixed costing. So we can go ahead and put those sales in there, the same as they are up here. 990,000 for small, 1,087,500 for medium, 945,000 for large. So interestingly, right, sales is actually the highest for medium, even though it's the one that they're concerned is losing money. So these add up, and the total's given to me right here, 022,500. Okay, our variable cost of goods sold. So we just look under cost of goods sold and variable costs, and we'll take this line right here. So 538,500 for the small, 718,500 for the medium, 567,000 for the large, which adds up to 1,824,000. And then to calculate our manufacturing margin, we just take the sales minus the variable cost of goods sold. So for small, 990,000 minus 538,500. For medium, 1,087,500 minus 718,500. So 369,000. For large, 945,000 minus 567,000. And then the total, 3,022,500 minus 1,824. That's the manufacturing margin. Then our variable operating expense, again, it's given to us right here. You'll notice I'm entering them as positives on the income statement, even though they're listed as negatives up here, just because typically on income statements, we show the expenses all in absolute value. So our variable operating expenses, 118,100 for the small, 108,750 for the medium, $85,050 for the large, And that all adds up to $311,900. Our contribution margin is just our manufacturing margin minus our variable operating expenses. You can also say that your sales minus all of your variable costs is the same. That's your contribution margin. I'm going to do for small 451,500 minus 118,100. For medium, 369,000 minus 108,750. And for large, and then our total would be 198,500 minus 311,900. 886,600. Okay, that's a lot of information. The chance of making an error is pretty significant, so I'm going to use a check right now. Looks like I got it all right, but you can see how even someone who's got lots of experience with this could make an error. So that's just a good place to use a check. So then we want to do our fixed manufacturing costs. So what we'll do is we'll just look right here under fixed costs under cost of goods sold. And our fixed were 779,000. And then our fixed operating expenses. So look under operating expenses and look under fixed. And the total is, whoops, 88,900. Our total fixed costs will just be our fixed manufacturing costs, 779, plus our fixed operating expenses, 88,900, is 867,000. And then our operating income will be our contribution margin minus our total fixed costs, 886,600 minus 867,900 is $18,700. Okay. So our second question is, based on the income statement prepared in one and other data presented above, determine the amount by which total annual operating income would be reduced below its present level if proposal 2 is accepted. So you can see right now that the medium size is actually has a positive contribution margin, meaning if we pull out all those fixed costs, it's contributing to the covering of those fixed costs, which means really getting rid of it's probably not a good idea. Even though it looks like it's losing money when we do an absorption costing income statement, that has more to do with allocation than it has to do with actual the actual costs. So remember up here, it told us that if we were to follow proposal 2, which is to get rid of the medium size, it would lower our fixed operating expenses by this much, 142,500 and 28,350. So to figure out how much, to answer question 2, to figure out how much our operating income would be reduced, what we're going to do is take our contribution margin for size medium, which is 260, 250. That's how much size medium is contributing to the covering of all of the fixed costs. And then we'll subtract from that the fixed costs that will actually change if we get rid of the size medium. So subtract 142,500 and 28,350. So our estimate based on this information is that if we get rid of the medium product line, we're actually going to lose 89,400 in operating income, which means we're going to go from positive to negative. So my counsel or advice to them would be that that's a bad idea. Let's check our work and make sure that's right, and it is. All right, so on to part 3, where it wants us to prepare an income statement in variable costing format, indicating the projected annual operating income for if we did proposal 3. So remember, it told us up here. So we'll start, I think we're just going to work our way all the way down small, because size large is going to be the same. it wouldn't change under this new proposal. But with size small, it tells us that it would yield an additional 130% in size small sales volume. So that means, like right here, sales for size small was 990,000. So an additional 130% would be this number times 1.3 plus the original sales. Whoops. Okay, I'm making mistakes here. There it is. So under proposal 3, we project our revenue or our sales of size small would be 2,277,000. Again, since I messed that up, let me just make that clear. We're going to take 990,000, which was what the sales was without this new proposal. And then we're going to multiply that by 130% or 1.3 to get the amount of additional sales we would get under this new proposal. And then we're going to add 990,000 to that because that 130% was additional sales plus the original sales. So 2,277,000. That is our projected sales. To find our variable cost of goods sold, what we have to do is come up and look at these numbers up here. And we saw that before we had a variable cost of goods sold of 538,500 out of sales of 990,000. So what we have to do is figure what that is as a percentage. So I'm going to take 538,500. That's the variable cost of goods sold for size small. Oops. And then I'm going to divide that by the sales for size small, 990,000. So what we're saying is that the variable cost of goods sold is 54.39% of the sales. So now I'm going to use this factor to figure out our variable cost of goods sold if our sales were going to go up by 2,277,000. So I'm just going to take this number, 0.5439, and multiply it by the new sales of 2,277,000. And that gives me my variable cost of goods sold. Remember that variable costs are variable in relation to the sales. So as sales go up, they're going to go up, and they're going to go up by the same percentage. So that's why we had to go up here, find variable cost of goods sold as a percentage of sales, and then multiply that percentage times the new sales to give us the variable cost of goods sold. So our manufacturing margin is just going to be our sales of 2,277,000 minus our variable cost of goods sold, 1,238,550. And that gives us a manufacturing margin of 1,038,450. Our variable operating expenses, we're going to do the same process. We'll come up here and we'll say before they were 118,100 out of sales of 990,000. So I'll do 118,100 divided by 990,000. That gives me a rate of about 11.9%. I'll multiply that times the new sales of 2,277,000. And that's going to give me a variable operating expense of 271,630. So my contribution margin for the size small will be the manufacturing margin of 1,038,450 minus the variable operating expenses of 271,630. 766,820. Again, I'm going to use a check because there was a lot of work that went on there. Looks like we're all good. So the size large will be easier because that won't change. So I'm just going to copy these numbers from this size large column straight down. So sales 945,000. Variable cost of goods sold 567,000. Manufacturing margin, which is sales minus variable cost of goods sold, $378,000. Variable operating expenses of $85,050. And contribution margin of $292,950. Yep. All right. So then to find our totals, we're just going to add these across. Our total sales were $3,222,000. Our total variable cost of goods sold, $1,238,550 plus $567, $1,805,550. Manufacturing margin, $1,038,450 plus $378,000. Variable operating expenses, and then our contribution margin. All right, our fixed manufacturing costs. This is where we get into this statement up here where it says the increased production of size small would utilize plant facilities released by the discontinuance of size medium. So we're just going to assume our manufacturing costs, fixed manufacturing costs, are the same with this new system. So 700 is our new proposal. Then our operating expenses, it tells us an additional expenditure of $85,050 for the manager's salary would be added to fixed operating expenses. So I'll just come up here and take the old operating expense of $88,900 and add to it this additional cost of $85,050. So our total fixed cost would be $779,000 plus $173,950. And then our operating income would be $1,029,770. So our contribution margin minus our total fixed costs of $952,950, $76,820. Again, I'm going to use a check because there was a lot of numbers. I could have made a mistake. Ooh, it looks like I did. So let's see where I made a mistake. And I can always double check. So I added these up and I could see I got a different number, right? I was off by 30,000. I can also do it this direction, right? I can do my manufacturing margin, 1,416,450 minus, and it comes out the same. So that's a good check. 1,059,770. And then that minus our total fixed costs. Will give us 106,820 in operating income. All right, got it all right. So last question, by how much would total annual operating income increase above its present level if proposal 3 is accepted? So remember, our present level, we figured out up here, was 18,700. So to find out how much it would increase, we just take 106,820 under the proposal and subtract what it was under the original 18,700. And that gives me an increase of 88,120. So in essence, if we stick with proposal 1, which is to continue what we're doing, we'll make an operating income of 18,700. If we go with proposal 2, which is to discontinue size medium altogether, we're going to actually make 89,400 less than we're making right now. And if we go with proposal 3, then we're going to make 88,120 more. So proposal 3 seems like the best proposal, as long as all of these estimates we had to make, right, that we would increase sales by 130, all of those things are true, then that would be the best option. I hope this is helpful to you as you work through the guided assignment, of course, but also through the rest of the homework. Hope you have a great week.